Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. And today we're going to be talking about how a trader might trade credit spreads. Yes, credit spreads aggressively. This is traditionally, I think, seen by many traders as being a conservative strategy, but today we're going to be using an example bull put spread to take quite an aggressive position, seeking higher potential reward. We're going to be talking about the pros and the cons of this sort of an approach to the strategy. We'll be placing an example trade before we're done. Lots to cover, but before we can cover any of that, let me say, first of all, hello to everybody who's chatting in out there in YouTube. I'm sort of the interloper today. I'm filling in for the day, but I still see a lot of familiar names out there. Hello, Catan and Bill, Ricebird, Mighty Quinn, Cardenas, Sharon, Chris, Richard, Will, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording, but be aware that you're invited to join us in the live streams. If you'd like to be here, this is a Thursday webcast series that kicks off promptly at 2 o'clock Eastern time. We would love to have you here in our live stream audience. And as a treat for our live stream audience members, my good friend James Boyd is hanging out in the chats. James and I have worked together now for about 2 decades, so he brings a ton of experience to this discussion. I think all of you know James, so say hello to James. And also, if you have an account with X, you should be following your favorite Schwab presenters on that platform. It's the best place to connect with your presenters in between the live streams. You can find James on X at James Boyd CS. You can find me on X at Cameron May CS. But let's get into this discussion of trading credit spreads aggressively. All right. Now, as we do, of course, there are going to be risks associated with trading, and yeah, certainly aggressive trading. In any case, bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Okay, so let's set the agenda for today's topic. I want to take a quick look from a technical perspective at a chart that maybe a trader thinks is likely to go up. So we're going to be doing a bullish credit spread on that stock. However, we're not going to be doing a high probability, lower reward trade. In this case, we're going for a higher reward potential. I'm going to show you how that might be structured to set up a credit spread. Yep, a credit spread with a higher reward than risk. And then we're going to be placing an example trade on the Thinkorswim desktop paper money platform. But of course, we're going to be weighing the pros and the cons of this trade. No trade is perfect. This is not a solicitation of aggressive trading of credit spreads. It's just an example of how it might be done. All right. So let's go right to the Thinkorswim desktop platform. And for today, I've selected Oracle. Could be a number of reasons why a trader selects a stock on which to trade a spread. Of course, they might have convictions regarding the stock, the sector the stock is in. Maybe they think it's a fundamentally very healthy company. But a few things that I would think that most options traders consider as they're selecting a stock. Number one, price per share. High price stocks tend to have higher priced options. They tend to have larger obligations. Lower price stocks have smaller obligations and potentially associated risks, but also greater volatility, pros and cons to price selection there. Liquidity can be a big consideration. Illiquid stocks tend to have illiquid options that have difficulties in the way their pricing makes them harder to trade profitably, the options profitably. But finally, some traders look at charts. So we're going to be looking at the chart of Oracle. And here's what kind of caught my eye. It's only one technical lens. It's not a guarantee of what Oracle's going to do from here. But I found it interesting that looking at this through a Fibonacci retracement approach, we see the stock really got a headwind or a tailwind right here, right there in April when just about all stocks started to rally, and Oracle raced up had a pullback, bounced and accelerated on an earnings announcement. What was interesting was the proportions of this move on Oracle. So when a Fibonacci trader is applying Fibonacci's, they'll typically look for this 161.8 as a potential target after a pullback from the initial move. So interestingly, when we got the spring forward here on this earnings announcement, look where it appears to at least to have terminated in the short term. Reached right up there, touched that 161.8, and then pulled back. So that's interesting. What might also be interesting about this to a Fibonacci trader is that we had from this second run up, which was actually right in proportion with what the first one might have projected. We had this big run up. How far back, when we have a strong increase in price, does a Fibonacci trader commonly assume a retracement is likely to extend? About 50%. Not everybody sees it that way, but that's a common approach in Fibonacci trading. When we have a sharp run up, a typical assumption is there's going to be some profit taking, pulling price back down in the opposite direction. And look at this, we never really closed below that 50% Fibonacci level. There were a few hours where we poked down below that, but we've been rallying off those lows. So for some, let me get rid of this first one, maybe a little bit cluttery, but for some, this run up and pullback and this advance where we're starting to make potentially higher highs and higher lows might be interesting, might signal the stock is ready to start moving back up again. Let's say that our trader here has that sort of an outlook. We have a stock that's had a nice run since April, bit of a pullback is maybe just a setup for another bullish run. And let's say they think the stock is going to go for another run. I don't know, maybe up toward these previous highs. Those look like they're up around 330-ish. You see that there? So let's plan a bullish spread trade on that assumption where the trader is thinking that we're likely to run up. Matter of fact, now that we've seen this Fibonacci, let's just remove that one too. So we get a nice clean chart, all right? Maybe our trader's outlook is that we're moving from here possibly up to the neighborhood of 330, maybe, by, let's say, that November 21st expiration. So I'm going to go plan a November 21st spread trade. And it's going to be a credit spread. Now, I've definitely run across a number of particularly newer options traders who have the sort of misimpression that credit spreads always have to be traded out of the money. They always have to be high probability. It's not accurate. Credit spreads do not have to, by nature, be conservative, lower reward scenarios. Credit spreads can be set up to be higher, more aggressive with higher reward potential, but there are trade-offs for doing that. So let's go do this. I'm going to set up a more aggressive credit spread. So I said we're going to be looking out here to the 21st of November. And let's sort of look at what a traditional credit spread trader might do. Now, traditional is always in the eye of the beholder. But as we look at Oracle, let's say that we're looking at, it looks like we have $10 wide spreads here, 280, 270, 260. For some, they might use delta just as a constant guide. And if they're looking for high probability, it's not uncommon to see traders just look immediately to, let's say, that 30 delta, which means there's only about a 30% chance that a contract will expire in the money. Or when we're doing credit spreads, which prefer for their contracts to expire out of the money, there's about a 70% probability of success on a trade where our short contract is at the 30-ish delta. So that's, at least in my experience, in my view, more of a traditional approach to credit spreads. So let's look at that one for just a moment. Let's say that we sold the 280 put, bought the 270 put, the $10 wide spread. I'm going to switch our spread here from single to vertical so that we can see how much of a credit that might be offering. And it looks like it might be somewhere between 315 and 355. Let's call it, right now it'll be about 345. All right, so we get a 345 credit on a $10 wide spread. Somebody do the math on that for me. If we've collected a 345 credit, but we have a $10 wide spread, what is the risk potential of that trade? It's actually $6.55. So we're getting into trade here where we stand to make $1 for every 2 that we have at risk. What if our trader doesn't prefer that? And as a matter of fact, they're looking at this chart and saying, so Cameron, wait a second. So you're risking $2 in pursuit of $1. Doesn't seem like a huge reward if I'm able to call this direction of the stock correctly. So let's enhance that reward potential. Let's go back to our trade tab. And instead of going out of the money, this is one step that the trader can take to actually reverse things, to go from low reward, high risk to high reward, low risk, but at the compromise of the probability of the trade. But that is, we're going to take one step. We're going to go from out of the money to in the money. And here, let's look at this one. Let's maybe look at our 300 or 310, 320 vertical spread. Okay, let me put that on a chart so you can visualize this. So here we are today, and I'm talking about maybe a trader selling the 320, which is going to be up here somewhere. Let's carry that out to expiration, and buying the 310 put. Let's get that as close as I can. That's close enough, right there. So selling the 320, buying the 310, creating a credit spread there. Now, how many of you maybe just had your blood pressure go up a little bit? Because we just changed the scenario quite entirely. The original trade scenario was down here at 270, 280. That was down here. If you like the visuals, I'll draw that in. There's 280. 270 is down here, where our preference is for the stock to be above our vertical spread as we get to that November 21st expiration. Well, the stock's already above that out of the money credit spread. That's what can make it so attractive to so many traders. Ooh, it's a high probability scenario. It doesn't pay much compared to the other, but it's a high probability trade. On the other hand, Greg, is your blood pressure boiling? Chris says this seems risky. It is risky. Yeah, this second trade scenario, it is risky, but it definitely could have, as Chris says, a nice payoff if it works. Okay, yeah, but with this this higher reward trade scenario, we need the stock to do some lifting. It needs to get up there above 320, whereas with that more traditional view, all we have to do is stay above 280. Again, you can see why that can be enticing to some, but small reward for being right when being right is the most likely outcome. Larger reward for being right when we're leaving the stock with some work to do. So this is the one that we're going to be pursuing today, selling the 320, buying the 310, but I want to talk about exactly what we're getting ourselves into if we choose this. There's our 320, 310, but let's lay this out over here. And actually, it might be helpful if we switch this back from spread, from vertical to single, so that we can see the individual elements. So here's our example trade. This is a short put spread, also known as a credit spread. And we're going to sell the 21st of November 320 put. And what do we see about the credit there? That's between $33, $33.45 and $33.75. Right in the middle is going to be about $33.60. So you can see, boy, big credit, but we're going to limit that somewhat with the other option that we're trading. We're at the same time going to buy the 21st of November 310 put. It looks like that's trading between $26.95, $27.30. Let's say that costs us $27.10. So if we're spending if we're receiving $33.60 and spending $27.10, how much of a net credit is that leaving us with? Remember, with our other trade, we were looking at $3 and change on that trade. The net credit on this trade, as it currently stands, if we're able to fill at this price, is $6.50. Wow, if we're collecting a credit of $6.50 on a $10 wide spread, what does that leave as the maximum theoretical loss, or the theoretical maximum loss? That credit, let me write that in here. It just disappeared. What happened? I thought I typed that in. I'm sure I did. Oh well, we'll type it back in again. In any case, Art says, what about the gap below? Risky? It's already risky. Doesn't even need a gap down. Now, for another trade, that could increase the risk. But in any case, maximum theoretical loss on this is $10 minus the $6.50 credit. There's only $3.50 theoretically at risk, and we're setting commissions out of this discussion for just a moment because they do play a role. It's not nearly as big a one as it once was, but we're just looking at the sort of raw numbers. So now let's look at the reward to risk here. With our original trade scenario, for every dollar of reward potential, we had $2 of risk. In this case, we flipped it. Very close, not exactly, but close enough. We have, for every dollar of risk, we have $2 of reward. So have we dialed up with this one step with going in the money on this credit spread? Have we provided a larger or higher reward potential? Yes, we certainly have. Yep. What that does, as a sort of a side benefit, is the trader doesn't have to be right as often with this sort of approach while still creating a successful approach to trading. However, we've got to look at the probabilities of success and failure. So it can be awfully attractive to say, wow, $2 of reward for every dollar of risk. Let's do this trade. Why would I ever choose the other one? Well, this is not a high probability approach. We can tell that just by looking at the chart. The stock is right here. Where does it need to be at expiration in order to be in position for its maximum theoretical gain? We've got to be up above 320. So this thing has some work to do. That's not an inconsequential distance that this stock has to travel. That's about $21 to the upside that we need to see before expiration in order for this to be in position for its maximum gain. If we can get there, hey, we're looking pretty good. Yeah. Kelly says, you definitely want to be pretty sure on sustained direction right up. Yeah, Kelly. Yep, no doubt. Is this a trade where the trader wants to put this on if they're kind of iffy? I don't know. It might go up. It might go down. I'm not sure. No, in that case, maybe they want to go for that first trade scenario. Just stick with the sort of classic higher probability, being more conservative, lower reward, but higher probability of success. Mighty Quinn, you say your brain just exploded a little bit? Maybe we can look at it this way. Okay. Let's look at these two contracts that we're getting ourselves into. The first one, we accepted a payment of $33.60. Obviously, we haven't done it yet. I'm talking in past tense as though this order has already filled. We'll see if we can get it filled for these prices. Anyway, but let's just assume the orders are filled. In fact, should we just do it? Let's just go do it. Then we can talk real numbers here. I'm going to go to the 310, 320. Let's change this back to a vertical. And I'm going to click on the bid price to create an entry order. Now this is going to generate maybe a 640. Looks like 650 is not looking terribly realistic at the moment. Maybe might be able to pull that off. Might be more like 630. Okay, that's already changing. But in any case, let's try to get into this for $6.30 instead of $6.50. That's going to leave about $3.70 of risk. $370 per contract. If we do 10 contracts, that'd be $3,700. All right, I'm going to do that. Let's do 10 contracts. I'm going to click confirm and send. Selling 10 of these verticals. 21st of November, 320, 310 put spreads. Trying to get at least a 630 credit. We'd have to subtract commissions, leaving us with a minimum acceptable credit of $6,287. Now look at that reward to risk. Ooh, max profit $6,300, not counting commissions. Max loss $3,700, not counting commissions. Sounds great. But let's send this order off. See if it is great. Let's see if we can get this filled. So here we are, we're requesting a credit of 630. Looks like the market price is closer to 650. I think we stand a pretty good chance of getting this filled here pretty soon. But there we go. Oh, look at that, 645. All right, so we need to change our numbers slightly. Let's go to our filled orders so we can see the actual numbers. So here's what we did. We just sold that 320 put for $33. We just bought the 310 put for $26.55. Oops. There we go. What's the difference between those two? Collected $33, spent $26.55. Net credit was $6.45. Again, setting commissions aside. That leaves us with how much risk? $10 minus $6.45 is $3.55. So we're off by a nickel. R1 says it's a $3,700 loss within the loss parameters of the account. Is it 1% or something? So R1, I don't typically teach this webcast series, so I don't know. In my webcast series, I will say we try to keep it at $4,000. Anybody that's watched one of my webcast series, like my long verticals and diagonals discussion, that's where we cap it. So is this within that tolerance? It is. Yep, 37.30. It's actually going to be $3,550. Okay. Jerry says, your probability is not good here, Cameron. You're exactly right, Jerry. We can't go into this blindly, right? So we can get kind of dazzled by the reward potential of a trade, but that's not unique to credit spreads. For some reason, people give it a pass on a debit spread. Oh, that's just the nature of debit spreads. That's just the nature of trading long calls and long puts. They're inherently low probability, and I'm okay with that. But for some reason, we carry this bias into the discussion with credit spreads. We try to say that they should be inherently high probability. No, they shouldn't. There's nothing special about these, different from other approaches. We just weigh the reward potential, the risk potential, the probability of success, the probability of failure, and tailor it to that trader's preferences. That's it. Tommy, you're raising another good point. Another one of the trade-offs for doing this way. When we go in the money with short options, what happens to early assignment risk from day one? It's elevated. It's always present, even if we're out of the money. But when we're in the money, we do have a higher risk of early assignment. Yep. Tommy, always make an outline of what I want to discuss when I'm talking about these things. Guess what's right there in my outline? Definitely discussion of early assignment risk being elevated on this approach. All right, but here are the realities of this trade that we've just placed. It still retains almost, not quite, but almost twice the reward potential as compared to the risk potential. That's because it's more likely that we're going to lose money than make money. I know that sounds like isn't that a short road to complete failure? No, nope. Because if the stock can do what our trader is hoping it does, they don't have to be right even 50% of the time to see this strategy work. Lola says, I'm shocked the trade is only down $25 on entry. If that's the trade on your activity page, yeah. When we trade options, there's always going to be a small loss right at entry because of the spread between the bid price and the ask price. The narrower that spread, the smaller the hole that we have to dig ourselves out of initially. So yeah, liquidity is a big deal. All right, but let's get back here. And I wanted to just break this down because somebody says their head exploded. Where do these numbers come from? Well, so we now have real numbers to deal with. Paper money, but real numbers. Someone just paid us $33 per share for the right to sell shares to us for $320. That's a problem if they sell us those shares when they're not worth so much. And that's most likely the outcome. If they wind up assigning that contract, they're doing it because the shares aren't worth as much. They can't get a better price somewhere else, so they sell them to us for $320. Well, at the same time, we spent $26.55 for the right to be able to unload those shares onto somebody else for $310 if we need to. Do we really want to have somebody sell shares to us for 320 just so that we can turn around and sell them for 310 and lose $10? Nope. That's what we do not want to have happen. With this trade, rather than having these contracts assigned and exercised, we just prefer that they just expire worthless. In what scenario do the contracts get assigned and exercised versus expire worthless? Well, if the stock doesn't go up, if this doesn't do what our trader expects, let's just say that it just kind of wanders sideways or goes up, but it just doesn't go far enough. Let me get rid of this one, by the way. We're not doing this trade, so I'm just going to remove these drawings down here. Okay. If the stock doesn't go up, let's say it's at $300 at expiration. Someone else has the right to sell shares to us for 320. Are they going to do it? Yes, they're going to do it. With very rare exceptions, they're going to say, hey, can't sell these shares to anybody else for 320. I can sell them to Cameron because I'm in a contract that says I can. And so they sell the shares to us. And we say, oh, shoot, I don't want these $300 shares. I'm going to sell them to somebody else for 310. Best I can do. Right? Stuck with the shares at 320, sell them for 310. That's a $10 loss, for which we were paid $6.45. That's kind of limited consolation. So a $10 loss on our stock minus the $6.45 that we collected in premiums leave this with our maximum theoretical loss. That's what we do not want to have happen. But I'll tell you, that is probably what's going to happen. This is not a high probability trade. I can say very confidently, probably this is what's going to happen. But if our trader gets their timing right, if the stock does go up, let's say it gets up here above 320, it's up there at 330. Let's say it's gotten back up to that resistance, and we hit expiration. Well, the stock's worth 330. Someone has the right to sell their shares to us for 320. Are they going to do it even though their contract says they can? Probably not. They could if they want to. It would be mathematically not the wisest thing to do. But they're probably just going to say, Cameron, I'm keeping my shares. They're worth more to me than 320. And that trade's done. Awesome. I keep their $33. At the same time, this 310 put gives us the right to sell shares for 310. We don't want to do that either because they're worth 330. So our investment here just expires worthless. If we retain $3,300 or $33 per share as a realized gain, but we have a realized loss of $26.55, what does that leave us with? That leaves us with our net credit, which is also our theoretical, I'm going to clean things up here in just a second, theoretical maximum gain. That's that outcome. I was going to clean this up. I just want to change the grammar here for a moment. There we go. I like calling them theoretical maximum loss and gain rather than, this thing is not agreeing with me today. There we go. Anyway, yeah, I prefer to call it theo max gain and loss rather than max theo gain and loss. Just a preference. Same deal. Anyway, so that's what we'd like to do. This is a trade where we like to see the stock rise up above 330 by expiration and have this outcome. Now, to go to the observation that several of you have made is this is not likely. Nope, it's not likely. It's more probable that we wind up losing the 355 than making the 645. What are those probabilities? We can actually see those if we come back to our trade tab. I'm going to switch our spread back to single. If we look at our delta is our probability that our contract expires in the money. What's the probability that our 320 contract expires in the money? About 61%. In other words, only about a 39% mathematical probability that that contract expires out of the money and we make our maximum gain. So is it a high probability trade? Nope. Is it a trade, though, that an aggressive trader who is confident in their directional analysis might choose to still pursue if they want to maybe triple their investment if they can get that direction right? Yeah, that's a trade that sometimes even a credit spread trader will take. So yes, credit spreads are not inherently high probability or low probability. There's no prescribed way to trade these. They're instead very customizable, very tailorable, very flexible to a trader's preferred approach. So, does this sound like a sales pitch for one approach versus another? I certainly hope it doesn't. I just like to explore the full range of possibilities for a given strategy, weigh the pros and the cons, and then maybe go ahead and place a trade. So that's what we're going to be doing today. Midquidity says, love this ultra bull trade. It's not a bad way to describe it. There's a lot of open interest in the money. So early assignment seems unlikely, still possible, right? We have to be aware. Early assignment risk is always present. It's elevated if we're in the money. So the trader has to be sort of comfortable with that going into this. So let's go ahead with our trade. How do we place the trade? Go to the trade tab and let's go to our strikes. Quick way to place this trade is to just switch this from single to vertical. Come to that. Well, we've already placed the trade. Now that I think about it, typically do these at the end. So I've gotten myself a little bit out of sequence. And so I'm thinking we need to go place the trade. We've already done it. That's okay. It doesn't hurt to show it again. Set this to vertical. Click on the bid price to create a sale order for an open order. And then we just customize this for quantity, or if we want to see if we can maybe get a better credit out of this, confirm and send. But since we've already placed this trade, let's go back here. We filled at a credit of 645. So what's our preference from here? Because somebody asked, what's the target on this trade? Good question. We know the most we can make is 645 out of this trade, theoretically. Maybe our trader's okay with even settling for less than that. Now, this is still an aggressive trade. If we take an aggressive position and then we start settling for conservative outcomes, we're kind of shifting back toward the original bias, aren't we? If we're trying to optimize the upside, but then we undercut it by settling for smaller rewards, we might have been just as well off to go for that higher probability trade right from the start. I'm going to keep this thing still fairly aggressive. So maybe we don't go for the whole 645, but let's go for at least, let's say, 80% of that. So if we collect an initial credit of 645, how much can we afford to spend while retaining 80% of that? Let's look at this. Let's go up to our calculator. 645 is our original credit. Let's multiply that by 0.2. That's 20%. We can spend $1.29 to close this trade out, and that would leave us with the bulk of the original credit, 80% of that original credit. So let's do that. Let's make that our target. It's just an example. Other traders might have chosen a different percentage entirely. I just like to show the math. Whatever your percentage is, whatever a trader's percentage is, this is the math that can be done. So we're going to put in a closing order at $1.29. Now, there's also a risk that this trade just refuses to cooperate. And so we may be moving, instead of going down and getting out at a lower price, we might be going up and having to spend more money to close this trade out. So what if we were to close that out, if we've gone the wrong direction, half the distance to our maximum loss? Okay? Our maximum loss is 355. Divide that by 2. Means that $1.78 in the wrong direction. Let's just pull the plug on this thing. Now, we don't even have to do this. As a matter of fact, a trader, even if they're putting in $1.29, I better write that down before I forget it. Target, you let me know if I'm writing down the wrong target. I think it was $1.29, wasn't it? If we get out at $1.29, if we successfully get out, that means we would be retaining close to, what, $5.30 of reward? Could we even just risk the whole 355 and still have a better than one-to-one reward to risk outcome? Possibly, yes. Right? Do we have to have a stop on this trade? Not necessarily. Never a requirement to have a stop or a target. But let's do it just so that we can see how the math is done. Let's say that we are trying to minimize this loss potential. So again, up here to our calculator, 355 divided by 2. If we're trying to cut that loss in half, let's say if it's costing us $1.78 more than we received to get in, let's just pull the plug on the thing. It's not working. Okay. So 645 plus $1.78 means a potential stop at 823. Now, some traders, you might round this off to the nearest nickel or whatever the preference of the trader is, but I'm just going to put them in as those numbers. So here's the way that we might do that. Let's go to our position. So we're looking at Oracle, go to our Oracle position here. I'm going to right click on that. Do we have, yeah, that's it. Right, I was just making sure I didn't have a stock on that. Anyway, from a previous trade, and I don't. I'm going to right click on that. I'm going to create a closing order. Okay. We're going to look to buy that back, but we're going to do this as an OCO order. Let's create a duplicate order here. So one of these is going to get us out if we've hit our profit target. What is the limit to how much we can spend and still get our profit target? That was going to be $1.29. Let's make that good till canceled. Now, on the other hand, if our contracts are increasing in value and we have to pay $8.23 to close this out, that would be a $1.78 loss. Let's put in $8.23 as our stop the bleeding trade. That good till canceled. There we go. So here we have two orders. One to get out if we're able to buy out less expensively for $1.29. Another to get us out if it costs us more, $8.23. That'll be our target or our stop. If one of them's filled, the other one is canceled. One cancels the other is the designation. Yeah, Art Vandelay, not an opposite order. These are both purchase orders to close out this credit spread. Sold to get into the trade, buy on either side to get out of it. So let's click confirm and send. Either looking to buy the vertical for $1.29 or buy the vertical if we get up to $8.23. All right. So yes, there are commissions on this trade. And a quick reminder here, due to potentially wide market or liquidity risks at the time of activation of the stop, if it gets activated, that order may be manually substituted with a limit order upon activation and worked until filled. That stop is not a guarantee that 823 is the worst the damage is going to be. It's just we'll buy back if it goes to that price or higher. Okay, so let's click send. Our trade is in. Guys, we've done it. We've accomplished what I set out to do today. I wanted to take maybe a somewhat less traditional look at a credit spread. How might it be traded aggressively? And I could tell from some of the feedback to some of you that felt wrong. Nothing inherently wrong about it. As long as we understand the pros and the cons, a trader shouldn't feel that a credit spread has been disqualified just because they are aggressive by nature. That is a strategy that can be applied aggressively, but we do have to understand what that does to not just the reward potential, but also the risk and the probability of success or failure of the trade. All right. Also, going in the money, short options, higher assignment risk. All right, guys. So I hope you've enjoyed this discussion. I'm going to let you go. We still have a couple of webcasts coming up, so go enjoy those. Hey, James, thanks for helping out in the chats. I do want everybody to be aware of the other educational resources or all the educational resources that are available from Schwab. Yes, it includes these live streams, but beyond that, make sure, first of all, that you are subscribed to our Trader Talks channel on YouTube, Trader Talks Schwab Coaching Webcasts. This is where you can join the live streams, which is fabulous. Can't make it, you can also catch the recordings through the playlists right here. And finally, if you have a topic of specific interest, you can do a keyword search right there. Like, for example, I kind of threw Fibonacci's at you today, and maybe you don't know what Fibonacci's are, so you could just type in Fibonacci. It's going to look through our archives and it'll find webcasts that cover that topic. For example, hey, who's this guy? How to use 5 Fibonacci drawing tools on Thinkorswim desktop. I used Fibonacci extensions today, but they're retracements. There are lots of other different tools based on Fibonacci's. There we go. Tommy, you're glad that I covered that? Hey, you're certainly welcome. Bryce Bird, glad you enjoyed it. Another thing that you can all make sure that you're aware of is if you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us in between these live streams. James is very active on X. So am I. If you reply to one of my posts on X, I try to reply right back to you. So you can find James here at James Boyd CS. You can find and follow me at Cameron May CS. Right. That's it. Go enjoy the rest of our webcast. Thanks for clicking the like button. That's always appreciated. I see 140 of you watching. 46 have already clicked the like button. That's like a pat on the back to your presenter. It also gives us a boost in the YouTube algorithm. So thank you. It's always useful to click that like button. But I'll look for you in my regular scheduled webcast series. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.